As market players remain confident of the revival in the investment cycle, let's hear it from policymakers. We spoke with the chairperson of the Parliamentary Standing Committee on Finance, Jayant Sinha. He says that we can expect a pacy, investment-driven and all-inclusive union budget to be announced by the Finance Minister on the 1st of February.
Today I have a very special guest with me, the chairperson of the Standing Committee on Finance in Parliament, Mr. Jayant Sinha, who also was the Minister of State for Finance and Civil Aviation a few years ago. Mr. Sinha, great pleasure to have you on the show with me, but thank you very much for joining in. Let me begin by asking you about the kind of recovery that we are seeing at this point in time, because most economists that I've spoken to agree that it's an uneven kind of a recovery. The popular term is to call it a K-shaped recovery. Is the government concerned about this uneven nature of the bounce back, and what can be done to address it?
Well, I think all of us are concerned, Udayan, about the recovery, and I think it has really three parts to it. Number one is the speed of the recovery, right? And of course, we want India's growth coming out of a once-in-a-century COVID pandemic to be definitely close to double digits this year, and then to continue forward at a robust 6, 7, 8% a year. So the speed of the recovery is, of course, very important. Second is the nature of the recovery, and we would like it to be investment-driven. Certainly, consumption will continue to play an important role in our economy, but investment is key. And that's why you'll see the government really emphasizing capital expenditure, emphasizing private sector investment, because investment really is the foundation for growth going forward. So investment-led, investment-driven is the second aspect of the recovery. And the third aspect of the recovery, obviously, is that it is applicable to everyone, so that it's not just restricted to a few, but that everybody gets the benefit of the recovery. And that's why you'll see that when it came again to the kinds of expenditure that the government has undertaken in the last year or two, those expenditures, while they have certainly targeted health and vulnerable populations, have also been focused on important aspects of the economy that have high multiplier effects. And that's why you've seen the National Infrastructure Pipeline, which obviously drives infrastructure. That's why you've seen the PLI schemes. You've seen ease of doing business getting lots of encouragement. So what we want to do is that as we come out of this COVID situation, that the recovery is fast, that the recovery is investment driven, and that the benefits of the recovery go to everyone, because we are stressing the high multiplier aspects of what can be done at this stage.
As you focus on these high multiplier areas on investment, would the government also pause to consider the plight of industry, specific sectors which have been actually scarred a lot more over the last couple of years? Areas like tourism, hospitality, aviation, retail, because we have seen a lot of credit impetus to MSMEs and sectors like that which were badly hit. But some sectors have been hit much worse than others. Should one expect the government's focus to turn to some of these beleaguered sectors?
The government's focus has been, Udayan, on these sectors that are touch intensive, that are high touch sectors, and where the restrictions associated with the pandemic have really made a tremendous sort of negative impact on their activities. And that's, of course, everything associated with, certainly personal services, certainly all of those that are related to travel and tourism, hospitality. And there, there's been concessional credit that's been provided through some of the credit schemes that are out there. There's been an effort to be able to provide support through various schemes and mechanisms where some relief can be provided. And of course, the liberalization and the streamlining of ease of doing business, all of these have been intended to assist some of these beleaguered sectors.
Now, you spoke about stoking investments, and that's clearly where the focus should lie. But what needs to be done, Mr. Sinha, to get India's investment to GDP ratio back up to those high 30s, which we had maybe a decade or more ago? But do you think it's only a matter of government trying to stoke it, or do you think certain ingredients have to fall into place? Because it seems to be getting stuck in the low 30s for the last many years.
Well, I don't think it's that easy to do a simple apples to apples comparison between what was happening about 20 years ago and now. The nature of investment itself has changed. There's a lot more leasing in the economy that's going on. For example, in the airline industry, you're leasing planes as opposed to buying planes. So that's changed qualitatively. The whole nature of the economy has become less capital intensive. People are getting more out of less. A lot of it has been digitized, where again the investments are not that necessary, and you can get by with a lot less. So you really can't do an apples to apples comparison between what was happening 20 years ago and what is happening right now. What we really have to look at is GDP growth, which of course we think is going to be very strong going forward. You've got to look at job creation, which of course in the high productivity and the export oriented sectors is starting to boom quite quickly. And you have to look at the kind of money that we are attracting into investments, both domestically through, obviously the stock market and other forms of investment, as well as both private equity venture capital flowing in from overseas, as well as money flowing into the capital markets, FPI flows. So if you look at investment flows right now, investment flows are at unprecedented levels. They've never been this high. And of course, government is investing in a very substantial way as well. And that's why this notion of investment-driven growth, I think, is really starting to emerge because of these big sort of investment flows that we are beginning to see.
You spoke about investment flows, so let me bounce off or tick off this one issue which I wanted to bring up with you, which is the issue of this capital gains tax waiver on bond transactions by foreign investors. Because it is one reason you will agree that India is not part of global bond indices. And the consensus view is that if India were to address this issue, we could get tens of billions of dollars coming into over the course of the next year or so, as India becomes part of those bond indices. Is that under consideration at the level of the government? And do you think we could have a resolution or decision on that soon?
So then I'm not a member of the government. I'm a member of the legislature. I'm a member of parliament. So what's going to happen in the budget, what the policies of the government are going to be, I think the government will address those. And they are, of course, best position to tell you about that. But of course, as you know, the government has been taking very substantial steps to open up our debt markets to enable global bond investors to come into India. We've attempted to remove the hurdles that are preventing us to being included in some of these important global bond indices. And all of these efforts are underway, and our companies have also been able to borrow quite intensively in capital markets overseas and raise ECBs, external commercial borrowings. At the same time, of course, we always have to be careful about capital flows, particularly debt flows coming into India, because we want to be in a situation where we can balance it in terms of our own external borrowings as well. So like in many other things in government, there's a trade-off here between attracting bond inflows and making sure that our external account is in balance and is robust. So that's essentially the trade-off that has to be thought through. But I think the government is proceeding methodically and in a very comprehensive manner to addressing some of these challenges that bond investors have brought up.
Since we are talking about the issue of debt, I also want your thoughts on, as an say the chairperson of the Standing Committee on Finance, because this is an issue which has come up, I presume, or I believe in discussions, the role of the Reserve Bank of India in the government's debt management. There is apparently a view that the RBI should be divested of that role. Where do you stand on that?
Well, then that debate, that discussion has been ongoing for a very long time. And again, like any one of these trade-offs that we talk about in government, this is another trade-off, because on the one hand, the RBI has a very clear mandate for price stability. They've been mandated to keep inflation between 2 to 6%, 4 plus minus 2. That's their explicit mandate. On the other hand, as the debt manager for the government, obviously they would like to keep rates at a level where the government can borrow comfortably. So that becomes a balancing act for the RBI. And there are many experts, economists, that have mentioned and advised the government that public debt management should not be part of the RBI's functioning, that it should become part of the government's activities, because the government is just one borrower. So the central government, in effect, is just one borrower among many other borrowers in the economy. And if you're just one borrower among many other in the economy, then the RBI should not be preferring the central government over other borrowers in the economy. So that is a strong view that many economists, many experts believe should prevail. And of course, as I said, there's been lots of debate and discussion about when and how to undertake the separation of these activities from the RBI, so that the RBI continues to follow through on its remit of maintaining price stability and letting the government become an independent borrower like other borrowers in the economy.
Staying on the subject of debt, Mr. Sinha, the one issue which keeps coming up in discussions is that the government plus state debt to GDP is now approaching 90%. I mean, while we are nowhere close to some Latin American countries and nobody's talking about a great implosion, but it is approaching a worrying level. Would you not agree?
I think the part that we really need to understand, Udayan, is what is the interest expense that we are incurring every year, and is that manageable? And of course, that's a function of interest rates as well. And that brings us back to the earlier discussion we were having of the RBI as a public debt manager and RBI as a monetary policy authority that has to set interest rates, right? So if inflation is going up, RBI, because of its mandate, will have to raise, its rates. And as you do that, obviously, the government's borrowing cost also increases, right? Today, out of the 34 lakh crores, 35 lakh crores, that is government expenditure, 8 lakh crores, right? So out of the 35 lakh crores, which is the government's expenditure, 8 lakh crores is actually interest expense, right? And if inflation is going up, then the cost of borrowing also increases, and 8 lakh crores becomes a larger number because government's interest rates have also gone up. So that becomes a big burden on the budget. And that is the problem with debt to GDP increasing. The more debt to GDP increases, 8 lakh crores obviously goes up, rates also go up. And then we start to get in a situation where the government's ability to deliver public services and support the economy is constrained because we have such high interest expenses that we are bearing. And so that's why the 90% debt to GDP is a number we have to watch. I will also remind you, Udayan, that when the Finance Commission and other expert groups have looked at this topic, they have said that the right debt to GDP level should be at 60%. Right now, we've reached 90%, and that's largely happened because of the COVID pandemic, where we've had to spend a very significant amount of money and take our fiscal deficit from 3%, 3.5%, which is where it normally is, to 9.5% and 6.8%, and so on. That obviously is going to mean that the debt to GDP is going to increase. And the more that increases, the more rates go up, then the more pressure there is on government expenditure. Those are the dynamics, the debt dynamics that we have to be watchful of. And I'm sure that the Honorable Finance Minister, the Honorable Prime Minister, completely understand these debt dynamics and are going to be very prudent and thoughtful about what expenditures to incur as a result of that. And that's why it's even more important for us to have investment-led growth, which can drive sustainable growth in the long term, and that can then bring down the debt to GDP and reduce the pressure that government is facing on that account.
On this point, the government is not just the central government, it is also the combination of all or collection of all state governments. What are your thoughts on the nature of state finances post-pandemic? Because, we keep hearing that the states cribbing all the time that they're not getting enough of GST transfers, and one can clearly see that their finances are not in good shape. And it's not only the central government which can spur growth.
So Udayan, that's not exactly true.
Yes, please go ahead.
So the state governments are doing much better than the central government in terms of their fiscal dynamics, in terms of their debt burden. We have, of course, provided them some relaxation because of the COVID pandemic. But essentially, all state governments under the FRBM, which is the Fiscal Responsibility Act, have to maintain their fiscal deficits at 3% of state GDP or lower. And they've typically maintained that. We've given them, as I said, some relief during the COVID pandemic. But even as we've allowed them to borrow more, because of the pandemic, they've actually not been able to spend that amount, right? So the deficits, which we thought would go up well beyond 3%, closer to 4%, actually are staying fairly close to 3%. So even as the central government has borrowed more and spent more and been able to spend more, states have not been able to do as much. And so the fiscal health of the states is actually at this stage significantly better than that of the central government, which has had to incur significant expenditures to get us through the COVID pandemic.
Let me turn to another issue, which is an important one, because you spoke about the credit cycle a while back. I want to ask you, as chairperson of the standing committee, about the Insolvency and Bankruptcy Code. Do you lean towards the view that that needs to be resurrected because it is not delivering along the lines that was expected earlier, and we need modifications and tweaks for a new IBC code?
So then we have done extensive work on the Insolvency and Bankruptcy Code. I myself piloted that legislation in Parliament, in the Lok Sabha and the Rajya Sabha. So I have, of course, seen it from when it got started. And there have been many, many amendments since then. And we have also issued from the Standing Committee a very comprehensive report on the areas that need to improve. There isn't anything fundamentally wrong with the code. The code is actually a revolutionary, game-changing set of guidelines and laws for resolving bankruptcy. The most important thing at this stage is that the execution of it, the working of the code, has to be strengthened and to be expedited. And there we have still significant vacancies on the NCLT, on the various benches. We need more people to come in. We need to have more benches as well, because the volume of work has gone up and, of course, is going to continue to be high because of the COVID pandemic. And then we need to digitize and streamline the functioning, for which we have recommended many measures, so that the NCLT processes can move in an efficient manner. So that's the primary requirement right now. The legislation, the laws, the rule book, I think is quite comprehensive, is quite well established, but it has to be managed, it has to be implemented a lot better. Then there are 2 or 3 other areas where the insolvency processes need to be extended. One is on cross-border, and certainly there is work to be done there. The other is in the pre-packaged area for MSMEs as well. Again, there has to be some work done there. And then we have also recommended that the code of conduct for creditors needs to be strengthened and established as well. So there are areas where the legislation and the laws need to improve. But by and large, our biggest challenge right now is to just make sure that we execute it much, much better.
No, I take your point about execution, but there are other wrinkles in the code which seem to be coming in the way. For example, I'll give you a couple of examples. One is the kind of haircuts which some of the lenders are forced to take. In the case of Videocon, which was a large settlement, I think the lenders lost about 95% of the original loans. The other issue is whether it is pragmatic to sell a large malfunctioning asset as one piece, or the value can only be realized by breaking it up into 4 or 5 different pieces and then selling them separately to separate buyers. These are not execution issues, these are fundamental issues. Would you agree that some of these need to be tweaked?
Well, then one of them is an execution issue. The other is one which requires some changes to the rule book. We have recommended changes on both those 2 dimensions that you've highlighted. As far as proceeds are concerned, so that you can recover more than you have been recovering in the past. We have said that execution has to be streamlined so that the asset value is not eroded so quickly. The longer the process drags on, the more there is an erosion of value. So we've said, let the process be done very quickly so the erosion of value doesn't happen as much. Number 2, we've said there has to be a code of conduct for creditors so that they can expedite and streamline this resolution process. And they shouldn't be of the view that as long as you've gotten past liquidation value, that's good enough. And third, we need to be thoughtful about what the benchmark should be. We are not prescribing a benchmark as such, but if the view is that the benchmark is liquidation value, which can be 10, 20 cents to the dollar, then that benchmark is not an appropriate benchmark. We need to do much, much better to be able to get value out of these proceedings. So on the first point, which is about what is the recovery? I think the recovery can be improved and made much, much higher if indeed these execution issues are addressed. Now, coming to your second question about being able to, sell a company in the insolvency process in different piece parts, we are in favor of that. There are certainly many companies that are conglomerates and have assets that will appeal to different kinds of buyers. And in those cases, the resolution professional and the insolvency process need to take that into account and proceed in that manner. because ultimately the goal that we are trying to achieve is a speedy resolution process with high recoveries. And so whatever can support that should definitely be considered.
Now, many of the lenders to these troubled companies, which you are trying to address, are public sector banks. And in the previous budget, the finance minister made kind of a commitment at least a wish that two public sector banks would be privatized. I mean, stakes would be divested from the government. That has not happened in the last year. I want to ask you, your independent view on whether you think public sector banks should be privatized, and B, what is coming in the way of being able to do these divestments in a very buoyant capital market scenario?
Well, then this question has been asked many times. It is the stated policy of the government of India that some public sector banks should indeed be privatized, right? And that, of course, is what was expressed in the budget also last time. What I think you can achieve through privatization is to make these public sector banks much, much more competitive and create much more value for the citizens of India who are the owners of these banks. So we really have to undertake a transformation of these public sector banks so that they can become more competitive, they can win in our economy and be able to compete with private sector players and other larger public sector banks. So we have to make our public sector banks, particularly the smaller ones, a lot more competitive, and privatization is a good mechanism for achieving that competitiveness. So that is the stated policy of the government of India that has been stated many, many times. And that is in fact what the Honorable Finance Minister is hoping to accomplish. Now, why that has not happened this year, it's difficult for me to say because, as I said, I'm not part of the government and we have not held hearings on this as far as the standing committee is concerned. So it's hard to say that. But definitely that is the policy of the government of India.
Well, you were not part of the government right now, but you were not very long ago a Minister of State for Finance. So you must have some knowledge of these issues. Is it a banking union issue? Is there resistance from that front? Because, in a difficult market here, you can say that the conditions were not right. But this year, market conditions were so buoyant. There were billions of dollars of IPOs. The government could have slipped in one public sector bank at least. So I'm not asking for the specific instance of this year, but given your knowledge of how these things work, why do you think it is taking so much time?
So then let me just speak on the basis of my own personal experience, because I was associated with the efforts, that went into IDBI Bank and of course Air India. So I know a little bit about how the disinvestment process proceeds within the government. And therefore, what are the considerations? Now, why it has not happened could be due to any one of these considerations, but there are at least 4 or 5 considerations that you have to take into account when you go through the disinvestment process. One is, of course, you have to see what the state of the capital markets is in terms of valuations and whether those valuations are above your reserve valuation and so on. So valuation, state of the capital markets, that's one consideration. The second consideration, which is perhaps the most important consideration, though it's not discussed very often, is whether there are, appropriate buyers on the other side, right? So even if you want to sell a government company, you need to make sure that there is a robust pool of buyers that's willing to buy that company as well, right? So you really have to take into account how deep and liquid that pool of buyers is before you can actually consummate and make some of these transactions happen. So that's a second very important consideration. The third very important consideration is that there are very often many liabilities, issues that have to be sorted out. In the case of Air India, we had a whole host of non-core assets like real estate, like subsidiaries, hotel companies that Air India owned and so on. And so we had to find a way to get those non-core assets out of the core operating assets of the company, which is what we did with an SPV structure. And that enabled us to be able to move forward as far as that disinvestment was concerned. Then there is a fourth consideration, which is the debt that a company has. Again, in the case of Air India had 66,000 crores worth of debt also on its books. So we had to find a way of resolving those debts as well, along with the non-core assets. And then finally, there are, of course, a whole host of workforce issues, including, for example, the union issues that you mentioned. There has to be a fair resolution of those workforce issues in terms of healthcare benefits, pension benefits, employment considerations, and so on. And it's only when you establish a consensus on those workforce issues that you can move forward. So all these are important considerations that have to fall into place to be able to make a transaction happen. Now, which of these, has been part of what the government has been considering for these public sector banks, I can't say. But typically, these are the 4-5 issues that you have to resolve before you can undertake a transaction.
Okay, my last question to you is about the cryptocurrency bill. I mean, I don't know whether it's coming in this budget session, but which way do your thoughts lean on the kind of bill and laws India must have to regulate cryptocurrencies on two broad parameters? One, of course, on whether it should be legal tender or just an investment class or asset, and B, whether it should have capital gains taxation laws like equities, or you prefer or you would advise another kind of taxation.
So then you're asking me very specific questions about cryptocurrency. Let me first of all clarify again that I don't represent the government because the government has to take its view on these matters that has to be reflected in the cryptocurrency bill that gets tabled in Parliament. When that's going to be tabled is a decision the government is going to make. So that's one set of perspectives. The second set of perspectives are those of the standing committee, and those perspectives have not yet been developed because we just did one hearing. And then, of course, we decided let's wait for what the government tables in Parliament. And then on the basis of that, the committee can formulate its own opinions, right? So that is also a process that is underway, and that will happen in a productive fashion only once the government tables its crypto bill in Parliament, and then we can form an opinion on that as a committee. Then there's a third set of perspectives, which is my own personal perspectives for whatever they are worth. And as far as my own personal perspectives are concerned, I think it's very important at this stage that there be a global consensus on how crypto assets should be considered, crypto tokens should be considered. We have in India a particular challenge, which is that we have capital controls, which many other jurisdictions don't have. So first, I think we have to wait for what the global consensus is and how these crypto tokens should be considered. And Singapore, Japan, the UK, many of them have formulated a view where they're largely being considered like an asset. The US still has not, decided how it's going to be considered. I think this is something that should be taken up through the G20 process, through the Bank of International Settlements, and there has to be a global consensus that gets created on how to think about these assets. Then, we have to bring into it the capital controls that we have in India, and we have to figure out technically how we can make those capital controls work. Because right now, with the decentralized nature of cryptocurrencies, capital can flow freely across jurisdictions, across boundaries. And so unless we technically work out exactly how we are going to implement our capital controls, it's not clear how India can establish a proper regulatory framework. But in all of these cases, Udayan, there has to be a balance between innovation, which definitely decentralized finance and crypto assets, crypto tokens, cryptocurrencies represent, and regulation, which is there to, of course, protect. Personally, I would say that I think it's possible for us to enable this to be a viable and well-regulated asset class. I think it's entirely feasible. But for that, India will have to take some very interesting and novel steps as far as the technical aspects of it are concerned, so that we can, in fact, maintain our capital controls. That will require significant innovation, which we are very capable of, but it will require significant innovation that's very different from what Japan is doing, Singapore is doing, UK is doing, US is doing, because all of those have open capital flows. And so they don't need to apply the kind of controls we need to apply. So those will require some technical innovations. People have come up with some ideas around that, but that is going to be necessary for us to make it into a well-regulated asset class where people can invest in confidence. Sorry for that long answer. I'm not sure then whether that is what you were expecting.
No, that is exactly the kind of clarity I was expecting, and thank you very much for that, as indeed for your time today, Jayant Sinha. It's been a pleasure talking to you. Thank you very much.
Thank you, Udayan.